This single piece of paper ruined an entire nation. August 1720. Exchange Alley, London. The epicenter of the greatest financial distortion in British history. The South Sea Company. In 6 months, its share price rose from £128 to over 1,000. And then it collapsed, destroying the savings of the British elite. We often dismiss this as mass psychological hysteria. But I am a diagnostician. I don't care about psychology. I care about the specific mechanical architecture of the system, because this exact mathematical structure is happening right now. Let's look at layer 1, the setup. The company was chartered with a monopoly on trade with Spanish South America. There was just one problem. Spain had no intention of opening that trade. By 1719, the company had executed almost zero actual commerce. So how did it become the most valuable entity on Earth? Layer 2, the systemic mechanism. The business wasn't trade. It was refinancing British government debt. Holders of government bonds could swap them for South Sea shares, but the company set the conversion ratios. This only worked if the share price kept rising to make the swap attractive. To guarantee that rise, they introduced the physical artifact of the bubble, the installment plan. Investors only paid 10% of the share value up front. They committed to future payments on a rigid schedule. Which brings us to layer 3, the counterintuitive reveal. The bubble did not collapse because people realized there was no trade. They knew there were no ships. The collapse was purely mathematical. It happened when the installment payment schedule outran new investor inflows. It was a legal Ponzi structure. Each round of new subscribers funded the prior round's gains. But in August 1720, subscription velocity slowed down. The math inverted. Within weeks, the system shattered. Isaac Newton, the man who codified gravity, lost £20,000, roughly $3 million today. He understood physics, but he didn't track the systemic architecture. Now, let's step into layer 4, the modern bridge. Look at late-stage AI funding rounds today. I've built a $2 billion company. I know how these cap tables work. They increasingly exhibit the exact South Sea structure. Valuations rise not because revenue justifies them. They rise because each round's markup justifies the prior round's markup. Paper gains on existing positions enable the next round. The underlying business is real. AI tools exist. They work. But the operational business is disconnected from the valuation trajectory. Layer 5, decoding the pattern. The collapse signal in 1720 wasn't a single catastrophic event. It was the moment net new capital inflow slowed. It dropped below the rate required to support the installment payments. The modern equivalent is identical. It's the moment venture capital deployment slows below the rate required to mark up existing positions. At that point, the entire chain marks down simultaneously. Layer 6, Diagnostic Takeaway 1, the operational cover trap. Founders inside bubble-structured rounds rationalize valuations by pointing to real product traction. The South Sea Company also had real ships. The presence of operational substance does not negate bubble math. The question is whether valuation tracks that operational substance or tracks subscription velocity. Layer 7, Diagnostic Takeaway 2, the framework. Track the metric the South Sea directors hid. Net new capital entering the asset class versus capital required to maintain existing markups. When the ratio inverts, paper wealth converts to paper losses. In weeks, not quarters. We build systems. We invest in systems. But if you don't understand the hidden architecture, you are just a participant in someone else's subscription velocity. Newton was a genius, but he played a game where he didn't know the math. Look at your current portfolio. Look at the cap table of the company you work for. Strip away the AI narrative. Look only at the physical mechanics. I have one question for you. Are you tracking revenue or are you tracking velocity?